If you had a place where you could put your money and you could earn 3 to 5% every year, like clockwork, just like that every year, and it was safe money, guaranteed money in some capacity, how many of you would say that that's a good day in the office? I'm trying to help you understand how to design a policy that works for privatized banking. One of the biggest problems are people set these up wrong. So building a banking system, you're building a foundation. If you're going to be a bank, act like a bank. Do what a bank does. Mimic a bank. What's going on, everybody? Welcome back to another week, another wealth webinar. So real quick, let me just preface what you're going to learn today. I thought in today's webinar, we would dive into our favorite thing to talk about, privatized banking. But really what I wanted to do is I wanted to hyper focus today on how the policies are designed. I've done YouTube videos on this. Many of you have probably seen them, but I've got a new way to show this. And I got prompted about this because so many of our calls with the money mentors. So in other words, if you were interested in getting started with your own BYOB policy and you wanted to start the infinite banking process, you would get on a call with one of our money mentors, which throughout the webinar, we'll put that link up if you want to book a call. But when you get on the call, a lot of people always ask about the policy. Now I get it. That's the one thing most people can kind of associate with because they understand what a whole life policy is. They sort of kind of understand that it's specially designed and engineered for the infinite banking concept and for private banking. But that's really all that they want to talk about. Where really what we teach is what R. Nelson Nash, the late R. Nelson Nash, taught in his book, Becoming Your Own Banker, which is the process called the infinite banking concept. So in today's webinar, we're going to start with the product because that's what so many people want to talk about. We're going to talk about the ins and the outs, the goods, the bads, and the proper way to design one of these policies for your needs and goals. And then what we're going to do is I'm going to transition that. I'm going to show it. We are going to show it in actual use. So I've got some slides. Steven's got some slides that he presents that shows the returns and how this works. But we're going to show you how it actually works in life, the process I'm referring to. Because I want to make this clear. I don't know what all of you are going to get out of this webinar, but I can guarantee you if you apply what you learn here, if you apply the infinite banking process, it will change your financial future. You don't even need to believe me. Yes, it changed mine. Yes, it changed Steven's, but there's over 10,000, I said that right, over 10,000 of our clients, just our clients in the US alone, that are using this to change their lives. And people are always like, I see it on TikTok, I see it on Instagram. Oh, that's a scam. Just the other day, I had a post up and it was not even, it was giving away books, my books. It was free books and then, inviting you to this webinar. And somebody's like, this is a scam. Don't buy into it. And I just asked them, I said, if this is a scam, please tell me, what is it that I teach? Of course, he didn't respond. But the thing I want to get across is the process is what's going to make you wealthy, not the policy, not the product. And it's very important that you understand that. So that's what I thought I'd go through today. But I also want to talk a little bit about the taxes and how you can make mistakes. I want to demyth I want to kind of, what do they call it? Mythbusters. I want to take some of the myths out there about the only and the best way to design a policy for IBC, which many of you, maybe would think that it would be 90-10. And if you don't even know what that means, I'm going to explain it. And I'm going to show you why that is not always the best solution. So that's what you can expect to get today. More about product design, the good, the bad, and the indifferent, and then how to actually apply this in your life. So with that being said, let's roll. But actually, I'm sorry. Somebody just mentioned this. Before we roll, I got to do what we are supposed to do, and that is read this little bad boy here. This is called the disclaimer. Okay, it says, any opinion expressed by me or my castmates is solely our own individual opinion, and it's not investment or personal financial advice. This content is for informational purposes only, and this information should not be relied upon for investments or other financial decisions. Nothing contained herein is financial, legal, or tax advice. The rest I don't need to read because we're not doing any affiliate stuff today. So there you go. Disclaimer out of the way. All right. Well, with that being said, Stephen, as I get into this, chime in at any time. You know this stuff just as well as I do, and I'd love your opinion. But if any of you have any questions as we go, use the chat. But if you got a really good question or one that you want addressed, please put it in the question, in the Q&A. Now, if I lose my voice, it's okay. I've been talking nonstop every single day, all day this week, so my voice is a bit shot. But we're going to just see how we can get through this. All right, first, and I'm going to stand out of the way because I know Helen made a really good point, is she said when I'm talking and I'm trying to reference the screen, if she wants to do a screenshot, she can't because I'm in the way. I'm blocking it. You know, I make a good goalie, you know, like this. But anyway, thanks, Brad, for reminding us about the disclaimer. So let's talk a little bit about whole life insurance. Okay, there you go. I said that word. It's almost like a swear word, right? Whole life. How's that make you feel? Some of you have been around the campfire for quite a while. Some of you have been here for a couple weeks, couple months. But how many of you are actually here for the very first time right now? Put I in the chat. I just want to kind of gauge how many of you are brand new to this. And I want to then make sure I address the proper things to attend to the people that are maybe brand new. Great. So we got Pete, we got Jeff, we got Matthew, Pamela, Jacqueline, James, Crystal. All right. So we got some new folks. So for all of you coming into this new, I really want you to answer this question. When I say whole life insurance, what is it that you think of? Put it in the chat. What's the very first thing that comes top of mind when I say that word, whole life insurance? Put it in the chat. And it'll be interesting to see this. Because I know when I first heard that word, and everything I was taught as a financial advisor is whole life is one of the worst places you can put your money, right? High commission. The only one making any money is the insurance company and the advisor selling the damn thing because the commissions are really high on that. What else would you think? You would think long-term. You would think, oh, great, I got to die to get my money. You'd hear all the things that you've been taught, which are all myths. Now, I'm not saying that whole life is not those things, because if you just buy a whole life policy from your broke-ass brother-in-law or broke-ass sister-in-law who just started selling life insurance, they're going to basically sell you a policy and have no idea how to design this. And this is a problem. Stephen and I see this a lot. It's actually quite a big problem. There's a ton of people that watch our videos. They kind of learn the infinite banking concept, but they got a relationship, right? They got a relationship with a buddy or, you know, somebody from school or a broke-ass brother-in-law that says, oh gosh, I can do a whole life policy for you. And then you might even be smart enough to say, yeah, but it's got to be specially designed and engineered for infinite banking concepts. And they'll be like, oh, I know how to do that. So you're like, oh, okay, cool. I don't need to use that Chris Naugle guy or any of his team. I got my high school friend. I trust him or her. So I'm going to have them do it. And I can almost tell you that everything you see out there about the infinite banking concept that's negative is because they used somebody that has no idea how to design a policy that works for privatized banking. I almost guarantee it because I see it all the time. Every person that's negative about this, I start digging in a little bit and I say, you know, what is it you don't like? Well, I got one of those whole life policies and they said it was going to do this and it didn't do anything. Like I didn't have any money in the first year to use. It's just a scam. Whoa, hold on a second. Can I see your policy illustration? Sure. Just the other day, a guy locally here gave me one of his illustrations. It was a Mass Mutual illustration. He says, you know, this thing was supposed to be so good and he pitched it as being this great thing. And look at it. It's crap. He's like, I've done the math, and his business partner's there. He's like, the thing's garbage. Just cancel it. Like, you'd be better off just taking your money and putting it under a pillow. And I looked at it and I'm like, oh, this is just an off-the-shelf whole life policy, not designed for anything other than the day you die. But then I went on to say, I said, you know, but really in the grand scheme of it, why did you buy this? And he said, well, I bought it for life insurance for my wife. And he's got a little one on the way now. And I said, okay, does it solve that problem? He said, oh yeah, but he's putting $5,000 a month into it. He's like, yeah, but I'm putting so much money. I'm like, yeah, but you got a lot of death benefit, man. And he's like, but it doesn't have any cash value. Like it's a dog. It just doesn't make any money. I'd be better off putting money in the stock market. And I said, what did you just tell me your goal was? To protect my family. That normal off-the-shelf Mass Mutual policy did exactly what he was told it was going to do. Protects his family. And then I went on and it was a limited pay. It was a 12 pay. And what that means is you pay premiums for 12 years and you never pay again. We don't design them using 12 pays, and I'll get into that in a little bit. But he went on and I said, listen, right here, if you look in the 12th year, You've put in, I think it was like $600,000 over the 12 years. And I said, you have more than $600,000. So at the end of the day, if you had your insurance for 12 years, you protected your family for 12 years, and you decided, I'm a self-made multi-billionaire, I no longer need life insurance, I'm going to self-insure. And you cancel this policy. Was that a bad place to put your money? How much money did you lose? Zero. You actually made money. You made 25 grand. I got these numbers in my head. Again, this is an off-the-shelf whole life. He had no early cash value, which I'll show you why. But after 12 years, he got all of his money back. And then every single year for the rest of his life, and he's a young guy, he's a little bit older than me. For the rest of his life, that cash value goes up. And when his cash value goes up, his death benefit goes up, which means his family gets even more protection should he die. Just call it automatic inflation protection, right? Because it is. Every year, the death benefit goes up. So then I said to him, I said, so what would have been your option here? And he said, well, I could have bought term. He said, you could have. You could have bought term insurance, which would have cost way less than $5,000 a month. And you would have put all that money in to get this much death benefit. Let's say it cost you $3 grand a year for term insurance, not 60 grand a year. Okay. But at the end of that term, let's pretend it's a 12 pay. Okay. A 12-year term, which it wouldn't be, but let's just say that it is. If in 12 years you didn't die, how much money did you get back for all that money you spent on that term policy? Zero. How much money did you get back for that whole life policy, that shitty whole life policy that you were sold by your friend? All the money you put into it, plus you had protection. Please, folks, tell me one term policy that gives you all your money back without you dying. There isn't one. But then people will say, oh, invest the difference. Well, I'm going to defer this, but I do want to cue you all up because this is awesome. So remember this. We are working on something right now. I should say Craig has been working on a science project. And that science project, what it's going to do is it's literally going to demythify, or whatever you want to call it. It's literally going to prove wrong all those buy term, invest the difference pundits out there that said that's the only way to go, the best way to go. We are so close to mathematically proving with a 100% certainty that you'd be better off doing a whole life and then investing your cash value in the S&P 500 and versus buying term and investing in the S&P 500. We did the same markets, same time frames, all the same things. We will show that video. We will actually do that webinar and then show the video later, but we'll show you that mathematically it doesn't. But anyway, all that put aside, let me just ask all of you a question. My friend that said he got a bad deal from his friend with that $5,000 a month whole life that he paid for 12 years, and he said it was terrible policy. It was an off-the-shelf whole life. That advisor that sold him that whole life policy made a boatload of money, a bunch. I mean, minimum, it was a $60,000 a year premium. Minimum, he made almost $40,000. How many of you would love to just make $40,000 selling one whole life insurance policy, right? Great, huh? You're like, heck yeah, man, that's better than, that's almost what some people make in a year. That wouldn't be a bad day in the office. But that advisor sold him that policy to protect him. That advisor didn't really do anything wrong, but the advisor didn't know how to design it the way I'm going to show you how. So listen, worst case scenario, what you learned today, you could take to your financial advisor, your broke-ass brother-in-law, and you could say, hey, watch this video and design me a policy. And don't even use us. That's fine. Or you could decide to book a call with one of our money mentors, have us design it the proper way, and then we will help you fulfill and implement your infinite banking concept and work with you every single quarter after. I bet you your broke-ass brother-in-law is not going to do that. So let's dive in. Whole life insurance, how does it work? Well, whole life is two things. Number one, it's going to provide a death benefit for your entire life. Very simply put, right? You get a death benefit that you can't outlive, hence the name whole life. Secondarily, part of the premium that you put into the policy goes into cash value. So you do get cash value. Now that cash value grows with guaranteed interest. How much is the interest? Well, it depends on the carrier we put you with, but anywhere from 3.25, well, I would say anywhere from lowest would be 2% guaranteed, to most of the companies we use are between 3 and 3.75. Okay, that's your guaranteed interest rate. Plus they pay dividends. Dividends are not guaranteed, but they've never missed one in well over 100 years. Right underneath cash value, I put the word safety. Why did I put safety? Because it's guaranteed. Okay, that's pretty safe, isn't it? But how much can you expect to make just on the whole life insurance policy? Forget about the infinite banking for a second. So I want all of you to take your infinite banking hat off, and I want you to just put on your whole life insurance hat, okay? Because we're just talking product, which, what did I say in the beginning? Can anyone repeat what I said? The product will never make you what? Wealthy. The process will make you wealthy. The product will solve a problem and make your money work more efficiently. So if we just talk about just the product, not the process, how much could you make inside of a whole life insurance policy? And I've got two different numbers here. So, Helen, if you want to take a screenshot, I'm trying to get out of your way. Two different numbers here, 3 to 5% net growth. So what does net growth mean? Net growth means net of cost of insurance, net of those filthy commissions those advisors, including us, make, net of the policy service fee, which is between $50 and $100 per year. Okay, those are the costs. Whole life insurance is so simple from a contractual standpoint because your costs are fixed. A whole life insurance policy, your cost of insurance, the cost to have the death benefit, is level for the rest of your life. It never goes up. That's very different than term insurance, very different than universal life, very different than IULs or VULs. Those costs go up the older you get. Okay, I want you to remember that. Level cost. So the cash value inside of a whole life will make you anywhere between 3 to 5%, not 3.5, 3 to 5% net. And that's called internal rate of return. Now, I'm being very cautious on how I explain this, because remember, we're talking about the internal rate of return. How much can you expect to make inside of a whole life insurance policy if you never take loans, you never do anything with the money, you don't use the infinite banking concept, you just buy the darn policy and you just put money into it? Well, you can make 3 to 5% if and only if it is designed and engineered the way that I'm going to show you. If you do a policy like my friend, you have your high school friend, your advisor, or your broke-ass brother-in-law design the policy, you can expect to make 1 to 3% net growth. And that would be if it's designed wrong. So real quick, let's just pause there. I'm going to go quicker as I go, but I'm just trying to kind of get warmed up here. Let me ask all of you, if you had a place where you could put your money and you could earn 3 to 5% every year, like clockwork, just like that every year, and it was safe money, guaranteed money in some capacity, how many of you would say that that's a good day in the office? Would that be good? Stephen, let me know what they're saying in the chat on this one. Like, I don't know. I mean, I could be crazy, but to me, 3 to 5% internal rate of return, that's a pretty good return. I'm not getting that on my bank account. I might be getting that on a CD, but it's only going to be for like 6 months or a year. You don't have a place where you can put your safe money and earn 3 to 5% every year for the rest of your life, do you? But hold on. I got one more. Stephen, let me know what they say in a second. What if that 3 to 5% was tax-free money? Do you know what that would be in a taxable account, like a bank account? You'd have to make, depending on your tax rate, we might have Jimmy Davison or some other CPAs, they could figure it out. But if you tried making 3 to 5% net inside of a taxable account, like a CD or a bank account or a brokerage account, you'd have to earn way more than 3 to 5%. You got to figure out taxes. This is tax-free growth. So, Stephen, what are people saying? Are they saying that that's a pretty good return?
Yeah, good. Yes. Yep. Much better than bank savings. Just starts there. Yeah. I was going to ask if it was tax-free. Absolutely. Yes. Good return to earn 3% to 5% per year tax-free. That's better. Great. Absolutely.
Well, this is awesome. So we can just stop here, folks. We literally can just end the webinar here. I've done my job. I've just showed you a place to put your safe money to earn a 3 to 5% internal rate of return, tax-free. Oh, and I forgot to mention liquid. You can access the money anytime. And you're not going to have the bank broker, like, when you go to the bank teller, not bank broker, but bank teller, and you try to take a big chunk of money. Let's just say you got 200 grand in your bank account. It's your money, right? And you go to the bank and you say, oh, hey, Stephen, what's going on, buddy? Yeah, hey, it's been a rough couple of weeks. And Stephen, the bank teller, says, how can I help you? Well, I'd like to take a withdrawal for 200,000. Stephen, role play with me. You're the banker.
Yeah.
I just need 200 grand. Yeah, I'll take it in large bills if you would.
Yeah, that's a funny joke, Chris.
No, I really need this money. I've got a lot of shit going on right now. I got to have that money. So, you know, if you could just do it in hundreds, and I really need that now.
I need you to fill out these forms and come back in about a month, please.
Oh, what forms for what? I mean, it's my money. I gave you guys this money to hang on to. I just need it back. That's all.
Yeah, we just don't have that.
Go in the vault and get it.
There's no vault, Chris.
Can I talk to a manager?
Hi, Chris. I'm the manager.
Can I talk to a vice president?
Hi, Chris. I'm the vice president.
All right, thanks, Stephen. That was good. That was really good. So has anyone, I'm just asking for a friend, has anyone ever gone into a bank and tried taking a large withdrawal? Or am I the only dumbass that's done that? Like, they won't give you your money back in one swoop. They won't. I went into the bank a couple of years ago. It was for a real estate deal, and I needed cash to pay a contractor. It was a big contractor bill, and you know, he wanted cash. So they told me almost what Stephen did. You know, they said I couldn't take it out. I literally had to put I had to put a request in and come back the next day. I'm like, no, I'm here today. I don't have time tomorrow. They wouldn't. So I don't know if any of you ever done that. See, within the insurance company, that does not happen. You click a button, or in some cases, you got to fill a form out depending on the amount of the loan and the state you live in and the company you're with. Mass Mutual, for some reason, you got to fill a form out every loan you do now. That kind of sucks, but whatever. You know, but you fill a form out and your money's in your account in 36 hours. No questions. I actually, that's a lie, because they do ask you 4 questions. Is this part of a divorce decree? What bank account you want the money to go into? And there's 2 other questions, but it takes about 2 seconds to click, you know, through those questions. So, all right, so that's the whole life. So I think right out of the hole, I'm doing pretty good, right? Like, that's a decent return. But let's keep going, because we now need to understand, how does that work? Well, now we're going to peel the curtain back a little bit, and I'm going to explain how a whole life insurance policy works. Now, a whole life policy works much like in a universal life or an IUL, but there's some big differences. First off, remember I said the premium deposits you do have a cost of insurance, okay? So there's a cost of insurance for the death benefit. So this death benefit, I'm just going to put cost of insurance. This is where the cost is in the death benefit. And that comes in a form of a premium. But you see, the premium deposit, the money you're going to put into the whole life. So how we do it, folks, is very different, especially for any of you here for the first time. If you've ever bought life insurance, the first thing you usually would say, and we get this all the time too, hey, I'd like a $600,000 policy. Stephen, how many times have you heard that? Clients like, hey, what would it look like if I did a $600,000 policy? Now, to us, we would be like, oh, you want to put $600,000 in premium deposit in? Oh, no. I'm talking about the death benefit. Oh, I'm sorry, Mr. Client. We don't build the policies that way. You see, we're building a policy for banking. So if you're a bank, and really that's what you're creating here is a private banking system, we need to know how much in deposits you want the ability to put into the policy. So you see, we do it very different. So if somebody said, I want to put $10,000 into the policy per year, so let's just use that hypothetical number of $10,000 in premium deposits, we would have to design and engineer the policy to say, how much of that $10,000 do we want going to the base, which the base, just so you all know, I actually should just call it a whole life, a regular off-the-shelf whole life. The base is what you'd get. It's what my friend got. He got 100% of that $5,000 a month went to the base, which means it drove up his cost of insurance because he bought more death benefit. You see, we don't do it that way. We don't do it that way at all. We want to minimize your expenses. So to minimize your expenses, we want the lowest amount in some cases going to the base and the highest amount going into this special rider called a paid up additions rider. Because the paid up additions rider doesn't have anything to do with the death benefit in terms of a cost, although it does in the future. But in the beginning, think of it this way. This is the easiest way. I'll keep this 5th grade. Imagine you want to put money into a policy, but you just want to take money out of your right pocket. Okay, I pull this out of my right pocket and I want to put it in my left pocket. But I don't want that money interrupted with anything. I just want to take it out of my right, put it in my left, because my left pocket said it's going to pay a better return than my right pocket did. Great. Okay. That is essentially what the paid up addition rider is. It's the insurance company allowing us to basically put money into their general account and then start earning uninterrupted compounding interest on it. So when we do that, when we design these, we're going to design them with deposits to the base and deposits to the paid up additions. And depending on the percentage we have into each one, it's going to create a cash value. And the cash value will look like this. It will never go down. It's really all you need to know. Your cash value in a specially designed whole life, like what we're going to be talking about, can only go up. There will never be a year, ever, ever, ever. It's almost mathematically impossible. There will never be a year that you'll have less money than you did the year before. So that should be music to your ears. So there will never be a day that you will have less money than you did the year before. But not only that, if we design it properly and we put a bunch of the money, or we like to say a bunch of that percentage of your premium deposit to the paid up addition, what it's going to do is drive up the death benefit. See how I have the death benefit going up? So let me explain how that works. If you've got a whole life, okay, I'll just draw a box. This is a whole life. A whole life has two things to it. One is a death benefit and one is cash value. Pretty simple to understand. Those are the two components of a whole life. And we put money into the whole life. And every time we put money into the whole life, you're buying a death benefit and you're increasing your cash value. So when we then take that whole life and we start putting money into the separate rider called the paid up additions rider, really what we're doing is we're actually buying little itty bitty tiny whole life policies every deposit we make, which means every single time we do a paid up additions rider, we're buying more death benefit and we're increasing the cash value. So see how the death benefit goes up. Now, Dave Ramsey will tell you that your cash value doesn't increase your death benefit. You die and your cash value stays in the policy. And he is right. When you die, you do not get your cash value back. But what he fails to tell people is when your cash value goes up, you are forcing your death benefit to go up. Because there can never be a time ever where your death benefit is less than your cash value. That cannot happen. It just can't. So therefore, the death benefit must go up in accordance with the cash value going up. But you see, what we want to do is our goals. We want to minimize the expenses inside the policy because we want to build an efficient whole life policy for the banking. We want to maximize our cash value, and we want to pick the right kind of insurance company because the insurance company absolutely matters. Not every life insurance company does what I'm going to show you. Not every life insurance company will work with what I'm going to show you. These are special insurance companies. Not really. They're actually some of the biggest life insurance companies there are out there, but they have to adopt or want or like the infinite banking concept. I beat that one to death. But you see here where I show your premium going straight, and then I show it dropping to base only. All the designs we do, depending on the percentage we have going to base and the percentage going to PUAs, will have an end. So your funding period, let's just call it 10 years. You want to build a policy that you're going to max fund for 10 years because you want to really build the cash value during your working years. After the 10th year, what's going to happen is this 10 grand you were putting in, you're not going to be able to put 10 grand in anymore. You might only be able to put 2,500 of the 10 grand in because 7,500 of that 10 grand might have went to the base, or I'm sorry, to the paid up additions. So we're going to drop the paid up addition rider and we're going to go right to base. And folks, this isn't a bad thing because later in the policy years, and I'm going to show this, okay? Later in the policy years, the base portion, which was the least efficient in the beginning, becomes the most efficient growth in the later years. You might not understand why or how, but it's okay. Just understand that in the beginning, if you had a policy that had 100% base, like my friends, you will have no cash value at all in the first year. You'll probably have no cash value in the second year. And in the third year, you'll have little to no cash value in the policy, but you'll have a nice death benefit. In the policies we design, it will be flipped. You will have high early cash value in the early years, high early cash value in the middle years, and high early cash value in the later years. Which would you prefer? No cash value or high early cash value? Right, I already know the answer, high. So how do you grow the policy the most efficient way? Okay, that would be my question I'd be asking at this point. Great, Chris. So it would kind of make sense, Chris, that if I put the most amount of money of my premium deposit to the paid up additions, that would reduce my expenses because I wouldn't need to buy as much death benefit, and I want as little going to the base as possible, right? Not really. There are a lot of rules. Of course, yes, we want to build a policy for the highest early cash value. And we definitely, if we're going to do that, need to pick major mutually owned life insurance companies. So these are some of the biggest life insurance companies there are out there. The ones we use, I'm not going to name their names, but they're the top 5. They're within the top 5. And we don't use all of them all the time. There's a couple we use more than others. So does anyone have any questions on any of this? I'm just looking at the Q&A. If you have a question on any of this, that's fine. Put it in the Q&A. I'll just come back. But I want to keep moving on. Fair enough? So as we go on, now we're going to talk about cash value, but we're going to talk about the important factors. Now, some of this is going to be a repeat of what I just said, but I'm going to break it down. I'm trying to do this in like a 5th grade level. So remember, the first thing we're going to ask on that call that we get on with you is we're going to ask, well, first, we're going to figure out what your needs and goals are. That's always first. Like, what problem is this solving for you? Why do you want to become your own banker? Why do you want to use the infinite banking concepts? What is it you're trying to accomplish? These are questions you need to be prepared with when you get on that call, because that's the most important thing, right? Yeah, I mean, I very much doubt any of you on here walk into a store and you just randomly just start buying things that you don't need. I hope you don't. Like, you just buy all sorts of crap that you have no need for, right? You walk into a store because you have something in mind that you want a product for. You're buying a shirt because you're going out to a club at night. You're buying a dress. You walk into a car dealership because your car's on the fritz. You want a new car. You're trying to solve a problem no matter where you're going or what you're buying. This is no different. When you come to us, you're coming to us because you have a problem you want to solve. Now, that problem could be a whole menu of different things. It could be you've got a bunch of debt you want to pay down, and you want to pay it down the most efficient way, which we certainly can help you with. You want to buy a car, or you want to get all the money back for every car you're ever going to buy, drive, and own. And you heard that you can do that with this process. You want to be able to make money twice on the same dollar. In other words, you want to make, you got $1, but you want that dollar to work for you twice and make money twice. Great. Yeah, that works here. You might want to buy a boat or a house or invest in real estate or be a lender on Private Money Club. Whatever the problem is, we need to know what that is. Number 2, we will ask you how much money you are looking to deposit. Notice how the framing is different. Not a premium payment, it's a premium deposit. Why do we call it a premium deposit? Well, because when you go to the bank, you make a deposit and that feels good. But when you go to your car insurance company to make your premium payment, it doesn't feel so good. And here, your premiums are your deposits. I already explained that on the prior one, because the majority of the money is going into the paid up additions rider, which is savings. You're saving money. You're depositing money. When you deposit money, you're going to deposit after tax dollars. This is very important. This is not a tax play. The internal buildup of the cash value is potentially tax-free and tax-deferred growth. But we're using after tax dollars. Think of a Roth IRA. When you put money in a Roth, you worked for money. You got paid your salary. It was already taxed. You take that money, you put it into the Roth, and whatever the Roth grows to, you take it all out tax-free. Got that? Same idea here. We're going to always be thinking in after-tax dollars. So, and how much of your after-tax dollars do we want going to the base, and how much do we want going to the paid-up additions? We'll cover this in a second. We want to build a policy for growth, okay? And we don't want that growth interrupted by taxes. So therefore, we want it to be tax deferred. Now, that I say this because life insurance, if it's deemed life insurance, it fits in the IRS code as tax deferred and potentially tax free. Notice this little star, this little asterisk. I'm going to put this down here, and I want to be very specific about this for compliance reasons. Your policy is potentially tax free if and only if it's designed properly. If it is not designed properly, which believe me, I've seen plenty of them not designed right. We've never designed them wrong, because we know how to do this, but we've seen a lot of people try to do what we're doing, and they don't know how to design the policy within the IRS code. And what is the IRS code called? It's called the MEC 7 pay, which we'll talk about that in a second. But before we get into that, let's talk about this tax-free portion. Loans. So I bet you a lot of you, well, either you do or you know about this, have equity in your house. And when you go to the bank, you take a home equity line of credit out. Now, let me ask you a question. When you take a home equity line of credit on your house and you use that money to go make more money, are you taxed on that loan you took from your house, that home equity loan? No, because it's a loan, right? And because it has to be paid back. So the IRS code is pretty good about that, right? So loans are typically not taxed. So the cool part here, though, is the difference between a home equity line of credit. So what happens if you don't pay a home equity line of credit back? What if you don't make your payments back to the bank on a home equity line? What happens? They eventually foreclose on your house. But let me ask you this. What happens inside of a whole life if you take loans and you never pay them back? Your death benefit will be lower when you die. That is it. Okay, that's not what we teach, but I'm just telling you the facts. The insurance company is never going to ask you for the loan back. And the reason for that is a loan is an advance of your death benefit. The insurance company literally is loaning you money from their general account, but they're subtracting it from your death benefit. They're using your cash value as collateral. So that's why they're tax-free. Now, if you took withdrawals from your whole life policy, which you absolutely can. You can take loans or withdrawals. But if you take a withdrawal, there's no interest charged on a withdrawal. You're literally just reducing your cash value, which also means you're reducing the balance that the insurance company is paying dividends and interest on. When you take a loan, if it's done with a proper mutually owned insurance company like we use, the loan will not be taxed first, but secondarily, if it's a non-direct recognition company, they will not recognize the loan, which means if you had 100 grand in cash value and you took $90,000 of that 100 grand out, the insurance company would still pay you interest and dividends on the full 100 because they didn't recognize the loan, even though you took 90 grand of that money out. If you took the same scenario, if you had 100,000 in cash value and you took a $90,000 withdrawal, you would only have $10,000 left in cash value earning interest and dividends. Fair enough? Okay. What if it's set up wrong? This is the biggest problem. One of the biggest problems. I mean, the biggest problem is IULs, but let's just assume whole life is whole life is whole life. One of the biggest problems are people set these up wrong. So what happens if they do that wrong? Well, your broke-ass brother-in-law sets up your whole life, says he's going to set it up for infinite banking. Designs it, figures it out, goes to his office manager, and they somehow concoct some, I don't know, designed policy, and you get it back. But for some reason, it doesn't look anything like the ones that Stephen or myself show you. It has hardly any cash value. Well, here's what it could look like. You put 10 grand in premium deposits into a policy that is designed with 100% base. You will have no cash value in the first year, no cash value in the second year, and very little to none in the third year. Or your broke-ass brother-in-law does you really sour and sets you up with what he says or she says is the fanciest, best life insurance ever since sliced bread, called an index universal life. But they probably failed to tell you that an index universal life has what's called a surrender fee. So you put 10 grand into the index universal life. In the first year, if it's just designed, you know, the way I've seen most of them, it will maximize their commission, but it will minimize your cash value. Even if it says you have $8,000 in cash value, you might only be able to use $1,000 because there's a surrender fee. Now, let me preface and explain a surrender fee. It's actually pretty brilliant. And I'm going to just come up here. So think of it as a surrender fee. Let's say I own the insurance company and you're my agent. And you go out and you sell an IUL. And you get a client to put 10 grand into a regular off-the-shelf IUL. And it produces a commission of, let's say 10 grand. So the client puts in 10 grand and you get paid 10 grand. So I own the insurance company. I paid you a $10,000 commission. I literally gave you 100% of the premium that client just put into his IUL. Then in 1 year from now, that client that put the 10 grand in decides they no longer want this policy. It doesn't do what they said it was going to do, you know, blah, blah, blah. They file a complaint against the agent. So me owning the insurance company, I basically kind of come down on you because you've now got a complaint on your permanent record because you missold the product to the client, promising things that didn't happen. But the client wants to surrender it. So I'm the insurance company. I'm smart. I designed this policy so that that $10,000 I paid to that agent, I don't lose that money. Oh, no, no, no. I'm the insurance company. I put all the risk on the client. So I put a surrender charge, meaning in the first year, if they canceled that policy, well, you forego your cash value. Even if that cash value had $9,000 in there, you don't get $9,000. You might get zero. You might get $1,000. It's not going to be much. And the same as the second year and third year. So all I'm trying to do from an insurance company standpoint, or all an insurance company is trying to do, that was just an example, is they're trying to recoup the commissions paid. And they do that through a surrender charge. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up. Okay, so I think we covered this, but there's a couple more things I wanted to hit. More base inside of a whole life equals more cost of insurance. Let me do that again. More base equals more cost of insurance equals more commission. Okay. So one thing that you'll see out there in the marketplace is you'll see a lot of people talking about 90-10. What does that mean? Well, that means that 90% of your premium deposit goes to the paid up additions rider, which is great, because if you did that, you've got maximum use of your premiums that you put in. So we could use an example of 10,000. That would be $9,000 of the 10 goes into the paid up additions rider, which equals the highest early cash value. And we just call that HEC fee. So if I did that, the 10 is 10% of the premium deposit. PD means premium deposit, goes into the base, which equals really death benefit and commission. The commission paid on the base can be anywhere between 50, it's pretty standard at 55, but it can go up to as much as like 90%. Okay, and that's just the base. The paid up additions commission is anywhere between 1% and 2% in most cases. So you can see significantly less. So by doing a 90-10, what you've effectively done is built a policy design that minimizes the expenses, because you got the lowest death benefit because of the base that you're paying cost of insurance on. You've reduced, hypothetically reduced the commission by roughly 90%. I mean, you could say 88%. You've reduced that agent's commission by 88%. But here's the problem. Let's go back and draw that little picture. Okay, here's your, I'll just do 10 years, wrong line. This is your premium. And down here is your cash value. So your cash value would be super high, really fast. So kind of just draw it that way. But what's going to happen in this is in the 10th year, if you were putting 10 grand in here and 9,000 of that was going to paid up additions, in the 10th year, we're going to drop that down. You're now only going to be able to put $1,000 in. Let me explain this. In the 10th year of any policy, any whole life policy, even a off-the-shelf whole life, the 10th year is going to be really efficient, meaning every dollar you put in, you're going to get more money back than the money you put in. If you put 10 grand in the 10th year, you're probably getting like $13,000 back. Understand that? That's a pretty darn good internal rate of return on your money. And the reason for that is simple. It's uninterrupted compounding interest. Your money's been compounding that whole time. So now, when the policy is in its most efficient point, now you can only put $1,000 in. How many of you would want to put 10,000 in when your policy is the most efficient? And how many of you would want to only put $1,000 in? If any of you understand math and understand what I just said, 100% of you would say, oh no, I want to put 10 grand in. So that's the first problem. The second problem with a 90-10 is, in order for a 90-10 to work almost 100% of the time, we have to put a term rider on. Now, I'm not saying there's anything wrong with a term rider, but it is an added cost. And it's an added cost that will eat into your cash value. And the other problem with the 90-10 is a lot of our clients, they don't want to just put in $10,000. Okay, they might have a goal. Let's just say they're going to do a premium deposit of 10 grand, but they want to buy something. They want to buy an investment property right out of the hole, and they've got money sitting in a bank account. They got 100 grand sitting in a bank account, and they're like, well, can I take this 100 grand, take it out of my right pocket and put it into my left pocket, because my left pocket pays me more. Remember, internal rate of return, 3 to 5%. So I want that 3 to 5 because my bank ain't giving me 3 to 5. So we say, sure, you absolutely can do that. We call that a dump-in deposit. And that $100,000, we call it a dump, that would all go to the paid up additions rider. But you see, if we dumped in 100 grand and we built a 90-10, what we're going to do is we are going to mech the policy. Now, the way I framed that up, you should have grasped that that's not a good thing. Because if I mech the policy, I have now entered the world of taxation. So if I build a policy that is supposed to allow me to take and build money and grow money on a tax advantaged basis, but now all of a sudden I mech it because I violate what's called the MEC 7 pay rule. So all that means is, I know it's fancy IRS terminology, but 7 means 7 years. Okay, so I'll just write years. Okay, pay means premium. Okay, so basically it's a test, a rule, and we'll get rid of rule. We'll put test here because that's easier. It's a test that the IRS is going to do every year for 7 years on a cumulative basis. And they're going to say, okay, are you putting in too much premium for the amount of death benefit you have in the policy? And if you put in too much premium for the death benefit, you enter the world of MEC. And if you do hit a MEC, if you create a MEC, if you're not 59 and a half, it's a 10% IRS penalty if you take money out, and ordinary income tax. So it becomes just like your 401k. You pay tax on all your gains, and then you pay 10% also on the gains. I mean, I don't think any of you want that. So back to the 90-10, a 90-10 can work, can be a good design, but if any of you wanted to do a dump in, well, this all of a sudden isn't a good design. Now what we might have to do is start redesigning the policy to be like a 75-25, which, just so you all know, is probably the number one design we do. Anywhere between a 70-30 and a 70-25 are probably the two most common designs we do, because we have a lot of clients that like dumping money in. And by doing this, we have built an incredibly efficient chassis that will solve a lot of problems. But you see, there's no one magic design. There's a lot of people out there saying that 90-10 is the best. Well, it might be the best for some of you, but it might not be the best for the rest of you. You see, every single one of you has different needs and goals. And because you have different needs and goals, you definitely have different policy designs you need to do. So if somebody takes out a policy to buy cars, and that's the sole purpose of that policy, then we know the design that's going to work best for that. You might be taking a policy out to pay off debt. Well, we know the policy design that's going to work best for that. You might have a big purchase you want to do and you want to dump a bunch of money in. Great, we've got a policy design that works best for that. And I will tell you, very rarely when we're working with clients, does the 90-10 fit the bill for the needs and goals. I'm just being honest. I did a whole video on this, but I just want you to understand why. And the reason why is exactly what I just showed. A 90-10 is like building a house with a very weak foundation. The base is the foundation. And remember earlier, I said the base in the later years is single-handedly the most efficient part of the policy. So real quick, before we go any further, I thought this would be a really good exercise because, I'm trying to help you understand a whole life policy, just the product. And then we're going to move in the last 30 minutes, we're going to move into the process. But what I did is, I've been doing this 21 years now, folks. Can't believe it. I'm freaking getting old. 21 years. In June, it'll be 21 years, but I'm just advancing a couple weeks here. 21 years I've been doing this, but many, many moons ago, I worked for a company called New York Life. So now, see, I can show this because these are my actual statements. I blurred out the policy number so you can't see that. These are my New York Life statements. And I don't know if you can see this, but there's 3 statements here. We get a policy statement every single year. I've got 2021's policy statement, I've got 2022's, and I've got 2023's. So what kind of a policy is this? Well, remember my buddy I said earlier did a Mass Mutual 12 pay? This is a New York Life custom, it's a 12 pay. It's literally a 12-year premium payment whole life policy. So I can only put premiums in for 12 years. Now, I'm going to come back to this taxes side, but I want to come over here and I'm just going to steal a slide because I just want to put it up on the board. So this is just a 100% base policy. You see, back in these years, I took this policy out in 2014. So I started in the industry in 2003. My first full year was 2004. So I was 10 years in when I started this policy. But here, let's just go through some numbers. And I just want to put them up. And these are straight off my statements. If any of you want to see them, I mean, it's right there. So I'm not making any changes to this. So I just want to show you a couple things. So 2021, this off-the-shelf, standard, run-of-the-mill whole life. It is 10 years old now. That's pretty freaking awesome. I started this policy with a $200,000 death benefit. My premium is, I'll just do annual, is $6,466. Okay, there it is. Death benefit, premium. That's what I started this policy with. In 2021, my death benefit was $218,998. Not bad. Death benefit went up $18,998. My cash value this year was $39,872 and change. And my dividend was $1,294.77. Okay. We're just going to go year by year. Everybody has those numbers, right? Nothing fancy there. But what I want to do is right at the bottom, it's kind of cool. They actually show you how much you made over the last year. So let me just read this. During the past year, your base plan guaranteed, God, I love saying that. Guaranteed. It's kind of, like that WWF guy or that guy that says, are you ready to run? I'm going to start doing that with guaranteed cash value increase was increased 5,000. So this year I increased $5,974. That was my increase. Plus, I had a dividend of $1,294 and change. So my policy grew that year with guaranteed interest and dividends. It grew by $7,268 and some change. That means in 2021, from 2020 to 2021, my policy made a net of $802.77. Ran out of room. That's how much money I netted. But hold on. How much money did I make that year? If I put in 6,466, I made 7,268. That's 802. What would be the way to figure out my internal rate of return that year? Stephen, do you know how to do that? This would actually not be internal. This would be my cash on cash return. I would take $802 and I would divide it into the premium, right? Because if I put 6,466 in and I wanted to know how much I made on my premium deposit that year, that's the number I made. So I would divide this into the 6,000. What's that?
12.4.
12.4%. Now, I don't know. Correct me if I'm wrong, folks. How many of you would be okay making 12.4% on a vehicle that is pretty much guaranteed? Anyone have a problem with that? That's 12.4. But hold on. I can't stop there. This gets way better. 2022. Okay, there we go. See right at the top. I don't know if you can see the date right up here. 2022. Just showing you I'm not making these numbers up. Let's do this. We'll go quicker now. So from 21 to 22, same things. Remember, death benefit, cash value, dividend, and then I'll put the numbers. So the death benefit now is $224,000 and change. Cash value now is $47,778. Dividend now is $1,537. 1 year difference. So hold on. Now we're going to go down. We're going to do the math. So how much did my plan grow at the very bottom? Guaranteed cash value increase was $6,184. Plus, I got a dividend of $1,537. That year I made $7,721, which means I made a net $1,255. Okay. What's the return? 1,255 divided into 6,466, 19%. How you like those apples? Anyone going to complain about making 19%? I'm just asking for a friend. But hold on, we're not done. Because it is not 2022, it's 2023. So I got my newest statement here. Here we go. Death benefit, $229,000. Cash value, $56,070. Dividend, $1,644. How much did my policy grow? Guaranteed, $6,406. Dividend was $1,644. Total growth was $8,050 for a whopping net growth of $1,584.69. Not too shabby. If I do that and I do the math on that, it's only 24.5%. 24.5%. I know some of you have really high-powered financial advisors. Super good. You know, they're trading all that fancy stuff. They've been buying NVIDIA and Apple and all those fancy-dancy Magnificent Seven stocks. I mean, how many of you, be honest, I want the honest answer, how many of you last year, 2022 to 2023, in your high-powered financial advisor account or 401k made 24.5%? Put I in the chat. Now, there should be some of you that did make that. But now comes the magic question. How many of you can look back in 2020 to 2021 and made 12, 2021 to 2022 made 19, 2022 to 2023 made 24? How many of you beat this with your stock portfolio and all the risk that comes along with it and all the taxes that come along with that and all the management fees that come along with that and all the advisor fee? Anyway, probably less than 1%. Probably less than 1% of you could match the returns I got in a stupid effing whole life insurance policy that isn't even designed for high early cash value. Am I missing something, Stephen? I am. Almost forgot. I am missing something. There's got to be something better out there. There's no way whole life insurance can be the reigning champion in 2024, you know, just like it was back in 1920s, just like it was back in the 1800s, just like it was when the Rockefellers, the Rothschilds, Ray Kroc, Walt Disney, and all those people used to use whole life. Morgan and Stanley, you know, the bankers, they used whole life. There's no way whole life is still one of the best vehicles to use for private banking. Oh, it's not. There's IULs now, right? And I remember when I was in the advisory world in the early 2000s, there was this newer product. It was all the rave. It's called the Universal Life Policy. Some of you might have these. And it was a really cool policy. You know, it had cash value. It had flexible premiums. So I could start my premiums at $1,000 a month, and I could then reduce them to $500 a month. I could do all sorts of fancy-dancy stuff. I had flexibility in my premiums. And then I had a death benefit, a level death benefit, none of that increasing bullshit. So I just had a death benefit here. And my cash value kind of went like this because my cash value in a universal life was tied to interest rates. I mean, interest rates. So they would peg me and they would say, okay, your guaranteed interest is 2%, but today you're making 4% or 5%. Or I think back then it was like 6 and 3. Actually, I know it was because I owned one of these too. I no longer do. So it was guaranteed to make 3 and it was making 6 then. Fast forward. Okay, fast forward to the Great Recession, 2008. In 2008, what happened to interest rates? Does anyone remember? Stephen, what did the Fed do to interest rates? The same thing they'll do next year.
Drop them.
Dropped them. So in a universal life, when they drop interest rates, what do you think happened to this 6%? It became 3 because it went to the guaranteed level. The policy was built and shown, the cash value was built and shown to perform at 6%. But now I'm only making 3. So now all of a sudden my cash value goes from that to this. Hardly what I thought I was buying into. But also now, truth be told, this happened. Now what the insurance company does is says, hey, because your interest rate's only 3%, and because the hypothetical illustration we did for you showed 6%, we need you to put at least a minimum of $1,500 a month into this policy to support that $1 million death benefit. But it's okay. You have options. So if you can't afford the 1,500, we can reduce your death benefit. Great. Or you could just surrender your policy and take whatever cash flow you have. This happened. Universal lives were blowing up left, right, and center. They were lapsing all the time. I spent years of my career just calling on what we called target universal life policies because it was an easy sale. I went out, I said, hey, I got bad news. Your policy is going to lapse in 5 years. But the good news is I can take this policy and roll it into a new one, or I can take this policy and in 1035 exchange it into a whole life and everything will be better. And they did it because they had no option. You don't ever want to be in this situation. But too many people will. None of you, you're all part of the 5%. You've all heard this. But you see now, in their ultimate wisdom, what they've done is created another one of these machines, another one of these policies. They know that ULs and VULs blew up in the 2000s. So now they have created what they call the ultimate, and they've got all the new advisors selling these. And isn't it funny, Stephen, how it always is the new advisors? It's the guys that have been in the business less than 5 years that are selling these damn things, almost always, okay? So how do these work? Well, all the same things. It's a universal life chassis. Oh, the one thing I forgot to tell you, very important, sorry. Let's rewind this a little bit. I got to explain this. Remember in that universal life policy? Okay, I'll just put that $1,000 a year. In that universal life policy, remember I said if interest rates went down to the guaranteed level, why did they blow up? Well, remember I mentioned the cost of insurance, the cost of that death benefit. Can anyone tell me what did I say about the cost of insurance in a whole life? Who can tell me? What is it? One word. Did anyone say level? Never goes up?
Rising, equal premium, fixed.
Fixed. Okay, good. So inside of a whole life, perfect. Inside of a whole life, the cost of insurance never goes up. It's fixed. Inside of a universal life, an IUL, a VUL, the cost of insurance does this. Every year you get older, the cost of insurance goes up and up and up and up. Why would they do that? They do that with term insurance. Well, they would do that so that eventually someday you're probably going to lapse the policy and the insurance company is going to win. You have an increasing cost of insurance that you can't do anything about because every year you get older. I'm sorry. I'm about to be 47. It's insane. My wife she turns 30 tomorrow. Or sorry, I said 30. My wife turns 39 tomorrow. My daughter just turned 4 last week. Like we all get older. And as you get older, your cost of insurance inside of an IUL or UL goes up. So in a UL, here's what they do now. In an IUL, all the same things. You have the flexibility of your premium. You have a guaranteed floor, usually about 1%. And you have not a stated fixed interest rate, but you have a participating rate, which they can put wherever they want. Let's just say you're going to participate in an index, and we're going to say that it's going to do 7% because we did an average. An average rate of return is a complete false bullshit lie. It's the biggest lie you've ever been told. But they say that you're going to make 7%. But then as time goes on and as the cost of insurance goes up, you don't make 7%. 1 year you do 8, the next year you do 4, the next year you do 3. 1 year you go down to the guaranteed level. You can't lose money. You can't ever go negative because you're participating. You're not actually buying the index. You're participating. So remember what I told you happened with the universal life policies? The same is going to happen with these. The exact same thing. And I'll tell you why it's going to happen even faster, because these policies are being sold with people that are being told, take loans, use IULs for IBC, which is prohibited by the IBC practitioners, okay? So Nelson Nash's organization, the IBC Practitioners Group, forbids IBC practitioners, which I'm thankful to say I am one, forbids us from selling IULs for infinite banking. There's a reason. If you start taking loans from this and any of the things don't work on this hypothetical return, the policy will lapse. You just watch. Call my bluff. Prove me wrong. In the next 10 years, you watch how many lawsuits there are from people that sold these IULs. You watch how many of these policies lapse. You watch how many of these people come crawling back to us asking us to move their stupid IUL into a whole life because they were sold a bag of lies. Sorry, getting fired up. Anyway, I'm sure we'll get a bunch of questions on that today in Ask Me Anything. Oh, by the way, folks, if I don't get to your questions today, we'll get to your questions in the Ask Me Anything happy hour, which is at 4:30 today. very last thing I want to hit here, and then I'm gonna hit some questions, and then I want to just wrap by showing you 1 or 2 case studies of the infinite banking concepts, the process, because I've only talked about a product. Talked about the taxes, some things to be aware of. If you MEC the policy, I already told you, it becomes taxable. But if you lapse or surrender your policy, like if you start a policy, take loans from your policy above and beyond the amount you put in, which is called basis, and then surrender it or cash out of the policy, if you take out more than you put in, it will be taxed. Because when you lapse and surrender it, you no longer have a life insurance policy, and therefore the IRS will gladly tax you on anything above and beyond your cost basis. So be very cautious about that. But to be tax-free, your policy must be considered life insurance by definition. And that's what we build. We build life insurance policies that work for banking. That's what we do. It's what we're very good at doing. There are all sorts of ways to use policies for retirement. And when you're doing that, you could take loans during your working years. And when you retire and you no longer want to take loans because you're not going to pay them back, we would switch to take withdrawals up to the cost basis, which is the amount of money you put in. And then we would switch over to take loans so that you have a tax-free retirement strategy. Pretty sweet. So just trying to get you to kind of understand the product. I brought another one of my other policies. This one's properly designed and engineered. This is a Mass Mutual policy. I'll just tell you this one real quick. Started in 2022. And from 2023 to 2024, my cash on cash return was 14.7%. 2022 to 2024, 2 years. From 2023 to 2024, by the math, right here, my statement, I made 14.7% that year. Next year will be more. The year after that'll be more. The year after that'll be more. So the reason I showed you 2 different policies. You see how this policy that I just showed you has a faster cash on cash return than the New York Life one, because the New York Life one is a base policy. I had no cash value in the early years, but in the 10th year, none of you would disagree or say that sucks. I mean, I gave you the returns. So now, with that being said, I want to show you something. I want to show you this. Share my screen. There we go. All right. So everybody, can you all see this screen here? So we've got this illustration here, just shows how much money banks have in BOLI, which is bank-owned life insurance. Then I got this, but let me make this screen big for you. This right here, okay, that you're looking at on the screen, this is a real client of ours. Can't give you his real name, but we'll call him Kevin. So Kevin was a real estate investor. Kevin had saved up a couple bucks in his, he's a young guy. As you can see right here, he's 38 years old when he started this with us, and that was a couple of years ago. He had 50,000 bucks sitting in a savings account, and he was saving $500 a month. So 50 grand, saving $500 a month. Everybody's got that. See if I can draw some pictures. Here we go. 50,000 bucks, and he was saving $500 a month. You can see it's actually $491. So we designed him a policy, and he had a purpose. When he got him on the phone, and he talked to our money mentors, his goal was in the next year, he wanted to buy an investment property, and that's what he was saving up for. So the plan that we designed for him was a plan that was high early cash value. This design, we call it the Slayer. So this thing was called the Slayer. But let me just show you how the Slayer works. He puts 50 grand in, and then he puts 491, which is $5,895 a year into the policy. So at the end of the first year, Kevin would have 51,554 of the 55,895 in his policy. So if you were to do the math, Stephen, I think that's about 91, 92% of his money. Why do I say this? I say this because I want all of you to understand something. I want you to understand that you're not going to have access to 100% of your money, no matter how we design your policy. You do a 90-10, you're not going to have access to 100% of your money. Just want to be clear.
And somebody did ask that, they said, isn't there a surrender fee within the first 10 years with the whole life?
No.
And so what you have available is basically that surrender fee. So, 9% the first year, but then you'll see as this goes on, there's, go ahead, Chris.
Yeah, but they don't call it a surrender fee in whole life because it's really not. A surrender fee is only universal life. And that's a misconception. A lot of people, and I know Dave Ramsey says that too. There's no surrender fee, but you could call it a surrender fee. The difference, that 9% or whatever that math works out to be, you could call that a surrender fee in whole life, but it's far better. You got 91%. So the reason I say that is it's very important that everybody understands in doing this, you're going to give up a couple years of growth. Okay. You're going to give up a couple of years of growth, but in return, what you're going to get is you're going to get, after that period of time, which right here, his is year 2, because year 2, he puts $5,895 in and he can take $7,141 in, which means his cash on cash return is 21%. Remember, I said year 2 of my policy was 14.7, but let's just pretend it took you 3 years to hit your efficiency point, which means you put money in this stupid whole life. The first year, you don't make any money. And why didn't you make any money? Well, I just explained that, but if you're coming in late, you didn't make any money because the insurance company charged you a cost for the death benefit. And they also had to pay us a commission, although our commission was drastically reduced. In this plan design, our commission would have been reduced by 75%. I think this is a Slayer, so 75% would have been our reduction in the commission from a normal whole life. And not only that, the policy service fee. Plus, you have no compounding yet because it's a brand new policy. So it takes a couple years to build up. But how many of you would be okay giving up growth and not having 100% of your money, maybe only 91% of your money available for 3 years, so that then after the 3rd year, for the rest of your life, you would make more money every time you put money in it? In other words, I put $1 in, I take more than $1 back. The next year I put $1 in, I take even more than I did the year before back. And every year, no matter what you do, no matter how bad the economy goes, no matter what the market does, no matter who's elected, no matter what war we're fighting, your policy every single year has more money than it did the year before. No ifs, ands, or buts about it. Would you give up 3 years of growth to make sure that you had that for the rest of your life? Because I'll tell you something, sign me up. Sign me up every day of the week. But some people, they just can't get over that. But here, Kevin, okay, here's a process and how Kevin would do this. Kevin's got 51 grand. Let me just ask, does anyone in here need a loan for 50 grand right now for 12%? See if we got anyone that needs 50 grand, 12%. Kevin's got 50 grand. He'll lend right now for a year.
Anyone need it?
50 grand?
Yes, gotta take
Okay.
it.
So we got somebody that needs 50 grand. What's the name of that person?
Yoli.
Yoli. All right, Yoli. Kevin's going to lend you 50 grand. Okay, we're just doing this role play. So now you got 50 grand and you're going to pay 12%. So Kevin takes a loan from his policy, which means his death benefit, if I had a death benefit column over here, would drop by 50 grand. Okay, so we just reduced his death benefit by 50 grand so that Yoli could get $50,000 loan. But Yoli's paying 12%. So 12% on 50 grand, whatever that works out to be, what would that be, Stephen? Would it be, why am I not doing that math in my head? 600? It doesn't matter. But anyway, so let me ask you this question. Kevin had 51,000 in cash value in his policy. Kevin took a loan for 50 grand. How much money is Kevin earning interest and dividends on? Not a multiple choice question. Anyone get it? Kevin started with 51,000. He took a loan from his policy for 50 grand. How much money is the insurance company paying him interest and dividends on?
Yeah, there we go. Helen got it. 51,554.
Awesome. See, Helen, all I needed to do is get my ass out of the way of the board, and you're rocking it here. So 51,554, even though he took 50 grand. Why? Because the 50 grand didn't come from his cash value. It was collateralized by his cash value. It came from his death benefit. So now he's making money on $51,000, uninterrupted compounding interest, while Yoli is paying him 12%. So he takes the 12% and he rolls that 12% back in as a loan repayment. Okay? Everybody got that? So now he's taking Yoli's interest that she gives him, repaying the loan, which means he still has full access to every single penny of money he puts back into his policy as a loan repayment. He lost no leverage of his money. He lost no liquidity of his money. But by doing just that one step, by being the bank and putting that money back into his banking system, he is reducing the loan. So every time he puts that money in that Yoli pays him, it is reducing the loan down, which means if the insurance company is charging Kevin 5% on the loan, now they're charging 5% on a loan of whatever that payment is. Steven, do you know what that is? 50 grand, 12%. Give me the monthly. I can't see the chats, and I don't feel like doing math right now.
Divided by 500 a month.
Yeah. So, okay. I knew, because I knew it was 1,000. I'm just like, why am I thinking this is wrong? $500 a month. So the first month that he does this deal, the loan is no longer 50. The loan is now 49.5. So now the insurance company is charging 49.5. And over the course of a year, he's going to knock $6,000 off that. So over the course of 1 year, now that loan that he's got is now going to be $44,000 getting charged 5%. But he didn't lose any access to this $500. I'm getting sloppy with my drawing.
I was going to say, I'm just glad that your drawing with a mouse is just as bad as mine, because you're a great artist.
Terrible. But it's okay. I'm getting the job done. But here, like year 2 puts 5 in. Now he can take 7 out. Year 5 puts 5 in, can take 74. Here's the cash on cash returns. Every policy we design is going to have a similar effect. And this is where people say this is a scam. They see these kind of returns. They see this. You put 5,500 in the 30th year and you take 21,000 out. Say what? In the 15th year, you put 5,500 in and you take 6,300 out. Say what? Every year it's more. This is just how it works, folks. There is nothing hard or complicated about any of that. Clear my drawings. There we go. All right. Now I'll get rid of this. Zoom is funky. But now let me just show you in theory how this actually worked. Whoops. So this is kind of what we just showed you. Am I sharing my screen, Stephen? You can see this?
Yes.
This is that circle. So I'm going to go back to my really crappy drawing. But remember how I showed you? It's just one circle we're creating, folks. This is the same thing I just showed you with the terrible drawing. But here, that was a $50,000 loan, not 23 grand. It was 12% lent out. So we'll just say Yoli's on Private Money Club. It was $500 a month coming back into the policy as a loan repayment. It's just a circle. But you see, every dollar Kevin puts in, okay, $500 a month. Every time he puts money in this policy, that money is able to make a spread twice. So remember, the cost of the loan is 5%. Kevin's policy, I think right now, that company is roughly paying 5.6. So 5.6 minus 5, spread number 1. And then 5 minus 12, spread number 2. He's making money twice on the same dollar. Maybe not in the early years. Remember I said it's inefficient in the first couple of years, but after that, it's efficient. We are just creating a circle. That's all we're doing. And inside this circle is the most important word all of you should already know, but it is called control. You 100% control your money using this process. This process, this circle, what I just showed, is called the infinite banking concepts. And this is exactly what all those wealthy families I was talking about have done. And I don't care if it's a circle using private lending. I don't care if it's a circle paying off debt. It's all the same thing. Just keep drawing the circle. This is my example of paying off debt. I had a KeyBank line of credit. You know, if you were buying cars, there's the same thing. And then I was going to lease the car. This is what I did with one of the G-Wagons. I bought the G-Wagon with my policy. I leased it to my company. My company paid the payments back to me. You notice how it's always payments back to me, back to my bank, my banking system, my private banking system. So I could go on and on and on with these slides, but I'm just going to stop there because I want to hit your questions. Is the insurance company still receiving interest, or does it go into the policy value? Now, Doug, so I think you're trying to make it kind of like a 401k. So the interest that the insurance company is charging on the loans, all right, you start here, you put money in the policy. You take a loan. We'll just say the loan is 5%. This goes to the insurance company, okay? You make that money go to work over here in, I don't know, a private loan. We'll just call it 12%, Yoli's deal. You take the 12%, goes around the bottom part of the circle, back into the policy. If you started with 50K and you subtract $6,000 every year in loan repayments, the loan repayments are coming from Yoli, okay? So that's her money paying interest. Every year, you're reducing the amount that the insurance company is charging you interest on. So this interest does go to the insurance company when there's loans. However, all of the money, remember Kevin had about $51,000 in the first year. He's got 51 grand earning interest and dividends, even though he took 50 grand out to give to Yoli. So it doesn't matter that they're charging 5%. You're being paid more than the 5% on your money. And this one is compounding. This one, as I just showed, is going down. In our 90-minute talk, which I've got I'm so excited. I'm about a day away from releasing a brand new 90-minute video, and it is epic. But anyway, in that 90-minute video, we literally show you how you can make money earning 4 when you're paying 6, because compounding interest versus simple interest, one is going up, one is going down. And that's what I'm showing. This one's going down because of the process, and this one is going up, your cash value. Hopefully that helps, Doug.
All right. Can you use this to build a business with bootstrapping?
Yeah. I mean, where else? So think of it this way. Who is that? Is that Alex? So think of it this way. If you were going to start a business, and I know I've started a bunch of them, early on, I needed to get loans from banks. So instead of taking a loan from a bank, what if you were the bank and you bootstrapped your business using your banking system? You'd be making payments back to your bank instead of their bank.
How many years does it take to start and run an efficient business? A policy sounds more efficient in the future compared to a startup.
I can't remember, there was a statistic a while ago that talked about that. Like when you start a business, you can expect to lose money for X amount of years. And I think that's industry dependent, but I think a restaurant was like 5 years. So it took like 5 or 7 years for your business to turn a profit. So you're right. Banking is the ultimate business. Make no two ways about it. Banking will always be the ultimate business. So building a banking system, you're building a foundation. And your foundation, your banking system is going to be far more efficient probably than your business. But I can't say that with certainty, but I love that analogy, because it takes 5 years or whatever to turn a profit in a business. And it took Kevin 2 years to turn a profit, me 3 years to turn a profit. Yeah, I mean, sign me up for the banking. Plus the banking continues to pay you without you having to work harder, longer, or take on any risk. Your business requires you to work longer, and take on more risk.
This is a piece I don't understand. Does the, say, $500 actually come back into our policy or back into the general fund?
With the loan repayment, I think they're talking about. So
be.
the $500 that Yoli was paying back to Kevin, that 500 goes to your cash value, because what you're essentially doing is, or that 500 reduces the death benefit. So in other words, it goes to the insurance. Well, hold on, let me think about this. Yeah, it's in your cash value. Well, here's the easiest way, and I don't want to complicate this, which is why I'm taking time. If you had $51,000, okay, to start in cash value, but you took a loan for 50 grand, the 50 grand loan didn't come from your 51 grand. So your 51 is still earning interest, but 50 grand of your 51 was collateral, meaning you did not have access to the 51 grand. If you took 50 grand, you only have access to 1,000, but you're still earning interest on the full 51. This is a good question. So you got $1,000 available, but 51,000 earning compound interest. Okay. So now if I put $500 back to the policy, it would be called a loan repayment. What I'm doing, and the reason you don't lose liquidity, is I'm actually taking away $500 a month from the collateral that I pledged with my cash value. So essentially, every single time I put $500, I do have $500 to use. Does that make sense? I'm trying to make sure I explain it the right way. And I could have just skipped that explanation, just been like, yeah, it just goes right to your cash value. But that wouldn't have been the honest truth. The truth is you're repaying the loan, which means you're freeing up your cash value from collateral, which means it's all the same. It's still just numbers on a screen. You have, all you care about is what money do I have available. $500 goes into your policy as a loan repayment. You have $500 when that check clears. End of story. Good question.
Let's see. On June 2nd, 2023, you mentioned in your presentation that dividends are tied to treasury yield bonds. That being the case, how do you surmise that when interest rates goes down, treasury bond yields goes up?
Well, I think I mentioned that one of the determining factors of the dividends is treasuries. That's because insurance companies invest so much of their general fund in treasuries, but treasuries aren't the only thing that the general fund's invested in. Your dividend is essentially a return of unused premiums. A simple way of saying it's profits. But in a mutually owned insurance company like the ones we use, the policyholders are technically like the owners. They're not, there's no shareholders, there's policyholders. So yes, treasury bonds in today's environment where we're at, because treasury bonds, the price is low and the yield is high, insurance companies are able to make more money because they can take your money you're giving them for premiums, they can invest that money in treasury bonds backed by the full faith and credit of the US government and earn a higher yield. Therefore, a higher yield on the general fund produces a better return for all policyholders. Hence, dividends go up. I know everybody wants short answers. I just don't like giving short answers on public webinars like this because there's a compliance thing. So I want you to understand a little bit more, and there's a lot more to unpack with that. But Jimmy, hopefully that kind of gives you an idea.
30-year treasury going up today.
Yeah.
All right. Daniel said, how do they charge the loan rate when you take it from your policy?
Well, it's charged daily. It's simple interest, but you're only billed once a year. So at the policy anniversary of your policy, you'll be billed for the loan interest for that prior year, but it's calculated daily.
And that's one reason why we say, like, if using your segregated account, if you don't have a use for that money in the segregated account, go ahead and put it back into the policy and pay down the loan, because you're only paying interest when the money's out. So, let's say you're getting charged 5.5% annually. Well, if you're paying that back throughout the year, you might effectively really only pay, 3% for the year or whatever the case is. Now, if you're using the money, there's no reason to flow it back in, because you're going to continue to use it, either make a spread, make the profit, or recapture money, or pay yourself interest, use it for banking. So, all right. Connie said, oh, got it. That's the nuanced answer I needed. Thank you. I was picturing the loan and policy as two separate ledgers, so I couldn't figure out where to place that repayment back in my mind. This clears it up. The insurance company is keeping its own ledger of my policy, and it's repaying my policy loan. Right on, Connie. As on mine, it seems is charged on the moment you take it.
Yeah, like I said, the interest is charged daily. So it is charged the moment you take the loan. So Daniel, you take a loan, the insurance company starts, charging interest on that loan, just like a bank would, right? Simple interest. But you don't pay. So a bank, if you took a loan from a bank, they require monthly payments. The insurance company doesn't require monthly payments. The insurance company asks for the interest at the end of the year. Yes, it's calculated every day. So every day, if you went in and you looked at your loan balance, it'd be a little bit higher because they're charging interest on it, but you don't pay the interest until the end of the year.
All right, cool. Just to clarify, Jimmy Davidson, who has been around the campfire, high-level CPA, comes to masterminds and everything. He said, on average, businesses take 2 to 3 years to become profitable. However, many factors determine profitability. While some small businesses fail within the first year, others with low startup costs can even be profitable in the first year. So I like that response, Jimmy.
Thanks, Jimmy.
Let's see. Sheila said, how does any of this look when they force digital currency on us?
So we work with a company called Infinio, which is very heavily pushing to bring IBC, the infinite banking concept, to the blockchain, which is essentially the digital world. So that's what it'll look like. You'll just have IBC, and all this stuff will be done in a digital form. Too many people worry about, listen, I'm not saying the digital dollar is good. I don't like it, but there's, you got to recite to yourself the serenity prayer. There's nothing you can do to change the US, or the world, I should say, going to a digital dollar. Nothing you can do. So stop worrying about it. Focus on things that you can control. And even if we do go, thank you. Even if we do go to a digital dollar, and your policy is basically, growing, with digital currency, it's all the same, because you live in the US. So whether it's the dollar, which today looks like this, okay, or the 100 looks like this, or this is just a number on a screen, like your Venmo, your Zells, all the other things that you use probably every freaking day, but you're like, oh, I don't want the digital dollar, but yet you're paying for dinner with a credit card, and you're transferring money with Zelle and PayPal and all the Venmo, and you're just like, I don't want a digital dollar. You're the one doing the digital dollar now. You're living in a digital age. Like, the dollars are digital. Like, everything just is a computer screen, money moving around in the computer screen. So life as we know it in a digital age of a digital dollar really is no different than it is today. I hate to say that. And I'm not trying to be a dick. I'm just trying to get people to start really focusing on the reality of it. Yes, we lose control because they can control everything with a digital dollar, but there's not a damn thing you can do about it. Some people are like, oh, I'm going to move. Great. Find another country that doesn't do the same thing. They're all going to do the same thing.
Daniel just said, interesting. Just an example. I took a 2240 loan, and on the next day, my loan balance was 2358. That sounds right.
I don't know what 8 is. Took a loan for 2240. I don't know how they do the math. I mean, I don't know what your loan interest rate is. I don't know the company have, but let's just figure it out. So what would that be? 2350 minus 2240. It's $110 divided into your loan of 2240. That's yeah, it's about 5%.
With One America.
Yeah. So okay, I know, actually, I'm sorry, Daniel, I know what they do. One America, so this is unique. So it's 5%, or it's right on the money. It's actually a little less, 4.9%. So Daniel, what they do, you took the loan. They're automatically assuming it's 5%, but that's an annual 5% rate. So they basically put in there that your loan balance already includes the 5%. As you repay that loan with the loan repayments, you'll see that number change. So they just work in reverse order because they charge you once a year. So they just front load your loan balance with the full 5% or 4.9 in your case. And then if you start repaying that, remember, you're paying a loan, they're going to adjust your number backwards. One America does it a little different. It's all the same at the end. It's all the same at the end. Yeah, I've had a couple of people call me or ask me about that. That's a good thing to bring up. It doesn't mean you're paying 4.9 every month. It's for the year. That's your yearly interest. They just calculated it early and included it early, and then it'll reverse as you start loan repaying. God, my voice.
He says, where is the money held in the whole life policy? So we want our money out of the banking system. So now my money goes into my whole life policy created by your team. Where does my money live now? We are still working with banks.
No, you're not. You're working with an insurance company. It's with a giant mutually owned insurance company. Very, very different. Everything's different about an insurance company from a bank. The way they operate, the way they have a long-term approach, the way they invest the money. They work on Austrian economics, not this new modern monetary bullshit. Like, it's totally different. Too much to unpack at the end of a webinar.
Yeah. A recording. Yes, we do record these and they go on the YouTube channel. So go to @the Chris Naugle on YouTube and subscribe, and you'll get alerted when the recording goes up. There's a whole playlist of these wealth webinars. You can watch past ones anytime. What if I pay in full? So Daniel's just saying, what if he pays the loan back in full next month?
Okay, so I don't remember your number, Daniel. Here, actually, whatever it was.
Yeah.
What if you paid in a month? What they would do is calculate just 1 month's interest. So let's say you paid that loan back, Daniel. They would charge you for whatever time you use that for. So it would only be whatever that number was I just used, 200 and some bucks, or like 4.9%. That's your annual. So divide that by 12. So I'll just do it. Let's say it was 250 divided by 12. So that's $20.83 a month. They would charge you if you paid it back and you only used the money for 30 days, you'd owe them $20.83.
Yeah.
It's a bit complicated because it's backwards, right? They're not charging you monthly interest, so they're just calculating. It's just numbers on a screen, but it's all the same at the end of the day. Good question, though.
Let's see. Crystal said, a child policy. Does it look similar to this?
Not really, because a child's policy, you wouldn't want to look like the ones that we just showed you. You'd want a child's policy to be better in the later years, so it benefits them because they've got longer longevity. So like my daughter's policy, I designed it so it was still high early cash value, but I only had access to about 60% of the cash value, and that's how I designed it. So, but in the later years, a child's policy is going to just be a rocket. So you want to, again, it's needs and goals, but a child's policy, in most cases, we're going to design it more to be beneficial in the later years, not as super high early cash value in the early years. But again, it's all just in how we design it. A lot of questions today. This is good. Can't believe my voice is not gone.
If I use my 401k as a loan to fund a policy, does that mean I will now have to pay back the 401k loan and the policy?
No, don't do that. I'm not even going to answer that. Just don't do that. There's nothing mathematically that makes sense about what that question was.
Do both One American LLIC, Lafayette Life, allow you to keep your loans as separate balances versus, say, Northwestern, where loans are required to be lumped together?
I think you're referring to like every time you take a loan, is it held separately? No, all the insurance companies are just going to do a cumulative loan balance. But on the outside, that's why we use a segregated bank account. And I actually do a note for every loan I take. So when I take a loan from my policy, even if I loan it to myself, like for business use or cars, I do a note. So a promissory note. So every time you take money from your policy, you should do almost an IOU, and you could literally just, it's your bank. So you could just on a piece of paper, like a fifth grader, just write IOU, borrowed $10,000 at 6% from my private bank, will pay $100 a month every month until paid back. That way now you've got paper trail. Listen, like, I know it's your money, folks. And I know that sounds monotonous and stupid to do that, but I'm actually being dead serious. If you're going to create a banking system, freaking act like you own a bank, mimic a bank. And there's not a bank out there that just gives money away without a paper trail for it. So it takes you a couple minutes to do a promissory note. Just do it. Like, don't make excuses. Don't take the easy way out. Don't take the shortcut. Just do it the right way. If you're going to be a bank, act like a bank. Do what a bank does. Mimic a bank.
Can the system obviously work with a high single premium policy?
Yeah. Well, single premium, it can, but every single premium policy will be a MEC. That's all you need to know. It'll be taxable. That's all.
Well, what you want to do is just do so like if you got 100 grand, but you don't want to do 100 grand a year, put the 100 grand in the first year, but then just do like 10 grand a year moving forward. So do a much smaller amount.
Exactly.
And that's going to be your ultimate banking policy, really.
We do a lot of those. It is very ultimate. Yeah, because now all of a sudden it's deemed as life insurance.
Worded in a weird way, but it's a good question. Would it mess up the way the policy works if we skip a year of paid ups and only pay the annual base premium?
Yeah, I mean, if you didn't make a PUA deposit 1 year, that'd be less money in your banking system. But the next year, you'd be able to make up that one that you missed, or, but the one thing I would say, and this is very important, so listen up closely. If any of you like go down to just base, let's say you set up a policy to be a certain premium deposit, which includes base and PUA, life gets in the way, and all of a sudden you can't make that same premium deposit. With all the policies we build, you have the ability to go down in premium and reduce the paid up additions. If you do, don't ever not make a paid up addition or a PUA deposit. At least do $10 a month or $120 a year, because the insurance companies can and will take your ability to put additional PUA deposits in after 2 years. Perfect. Well, before I completely lose my voice and can't do any of the podcasts I have tonight, I'm going to call it quits for today. So folks, I hope you enjoyed this episode of the Wealth Webinar. I hope you learned something, and thank you all for sticking around. Your time is so valued by us because your time is the most valuable resource you have. So thanks for spending the last hour and a half with us. And sorry about my voice, but we will be back at 4:30 for Ask Me Anything Happy Hour. So we'll see you there. And if any of you are looking for the recording, just go on to YouTube and type in @the Chris Naugle, subscribe to my channel, and you'll find this recording there. With that being said, thanks everybody. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.